Hello everyone, and thank you for tuning into this update. I'm Joshua Dobi. Happy New Year to you. I hope that you had a blessed holiday season and hopefully had some time to shift down and to move away from the stress of ordinary life for a couple of days, and hopefully to spend some time with friends and with loved ones and all that goes along with that in whatever ways are good to you. Hopefully you didn't have too much cold weather unless you really like that kind of thing, and were able to enjoy that season for you. Appreciate you making the time to tune into this update, and because I do respect your time, I'm going to go ahead and get right down into it. As we turn over the calendar year, there are all kinds of things, especially because we had a presidential election in November where folks are talking about what they anticipate here for 2025. And I'm certainly not going to make this a comprehensive video in talking about all the things on our radar screen. I'm going to highlight a couple of the big ones that are sitting out there from a financial and economic standpoint that I think are appropriate for you to keep in mind. Obviously, we'll have a number of updates again this year as we go through the peaks and valleys of the financial and economic universe here over the course of the next several months. But just a couple of things to keep in mind as we get started on things. First one, very easy to start here. It has to do with the markets. Now, if you are one who studies the markets and performance history and where things have been, you know that we've now had back-to-back years, 2023 and 2024, of significantly above average returns as measured by our most popular stock indices. So I'm looking at things like Dow Jones Industrial Average, S&P 500 Index, and the NASDAQ Composite. Significantly above average for 2 years in a row. I don't mean to prick the balloon, but that's very, very unusual. For us to get another super positive year this year, the near-term example of that, the only near-term example of that is the late 1990s. So we're talking about near 30 years ago when we were in a space where we had three consecutive superlative years as measured by our most popular stock indices. So from a probability standpoint, it is unlikely that we're going to have a repeat of 2023 and 2024 market performance. Now, that being said, does that mean that we see some kind of financial or economic cliff out there? Not at this time. We certainly do have our headwinds. We certainly do have a significant amount of financial challenges ahead of us. I'm going to bring out two big ones here just as a means of this conversation. I'm looking at our national debt, which has exploded in a negative way here over the last 5 years. I'm also looking at entitlement programs. We're getting close to the clock into the clock dinging midnight, and for us needing to address these kinds of things from a financial standpoint, looking at Social Security, Medicare, and Medicaid. Now, when I say this, I'm not doing it to harbor fear on your end of things, but these things have to be addressed. Let me just take a look at the national debt very quickly. You know where interest rates have moved here over the course of the last couple of years. That also has applied to debt or to bonds that have been issued by the national government, by the federal government. And what that means is bonds that they were able to issue at 1% and 2% here a couple of years ago, meaning 1% and 2% of cost, now they're needing to issue at 3%, 4%, even 4.5% right now, which doesn't sound like a lot until you do that on a percentage basis. We're talking about 2 or 3 times higher interest expense for those same bonds which they need to issue to fund the federal government than just a couple of years ago. That puts a crimp on the budget and moves us into a deficit kind of space, which is where we are right now. We can float along, and some folks say, well, we'll grow our way out of it from a productivity standpoint. That is mathematically and academically possible, but relatively unlikely at this point, in my opinion. So we're going to need to address the national debt. We're also going to need to address funding for our entitlement programs. Now, I've spoken with many of you about that, especially about Social Security, for the obvious reasons, because we look at Social Security, especially if you're close to retirement or in retirement, about its sustainability and making sure that it will be able to keep its promises that it's made to you and for which you have paid over the years. At this point, I don't see a reason to be concerned about the folks who are either receiving Social Security payments or who are relatively close, i.e. in the next 5 to 7 years, scheduled to receive Social Security payments. There's going to need to be a change in the algorithm, though. My anticipation, this is just literally subjective projection at this point. I don't have any idea that this is how it's going to work. But for folks who are younger than, say, age 40, I anticipate there are going to be a couple of things that happen. One, we're going to get an increase in the amount of Social Security tax, which is collected. And two, there's going to be some level of reduction in future benefits, again, for younger persons who may be a couple to several decades out from receiving those benefits. In my opinion, at this time, that's how they're going to make that kind of entitlement program balance and then be sustainable over the long term. So I don't believe that it's going away. I don't think any politician on the planet is going to allow for that to happen. So I anticipate that that's going to be the way in which they adjust it from a mathematical standpoint in order to make it sustainable over a long period of time. I think that's going to be the same thing for Medicare and for Medicaid. Obviously, with Medicare and Medicaid, there isn't a direct payout to recipients, meaning it's done in the form of paying for our health care. I anticipate that there's going to be an increase in Medicare taxes as well, so that's going to be the way in which they balance that out. How much is it going to be? Who's going to be impacted? It would be, I think, a little bit careless for me to project how that's going to happen, but it's just math. We're going to need to have more revenue or income into the system via taxes in order to be able to provide in the most significant ways going forward. By the way, just a little bit of a sidebar, when it comes to Medicare, this year is anticipated to be the peak from a numbers standpoint of the number of people who are turning age 65 in the baby boom generation here in 2025. So it's going to be the kind of space where we're going to be able to identify quickly what kind of strain is going to be on the system, and hopefully then able to identify what kind of funding is going to be needed for the sustainability of that system ongoing. Now, I'm not talking about towards arguments about the investment of the Social Security Trust Fund or about the amount of waste and fraud in the Medicare and Medicaid systems. All very true. That's beyond the scope of what we're talking about here, that those things need to be addressed, certainly from a financial standpoint, and I anticipate that they will be at some measure in this next administration. There's going to be a balance. There always is between benefits provided and the funding that is necessary in order to provide them. So that's the first big thing when we're talking about deficits here and when we're looking at 2025 and we're looking at markets here for 2025. Second big item, interest rates. And they're correlated, but they're definitely separate. So we're looking at interest rates, especially towards the end of last year. There was a lot of speculation that the Federal Reserve would continue to cut the overnight lending rate in substantial ways here in 2025, even as much as 6 or 7 times additional beyond the cuts which were made in 2024. We had a lot of cutting that happened in 2024. Folks, I don't think that's going to be the case. It may happen. Can always be wrong. Again, this is part of when we're talking about looking into the future, that things may adjust along the way. I don't anticipate at this point that that's going to be the case. Inflation is pretty stubborn, and also some of the programs which are anticipated to be implemented, especially with regards to a whole basket of tax laws which are scheduled to sunset this year. Some of those laws may get made permanent or be extended. Those are going to have inflationary pressures associated with them. So I anticipate we're not going to get back to that 9% spike in inflation that we had here a couple of years ago, but we could be more in the 3 to 4% range of inflation. Even though the Federal Reserve has a target of 2%, we could be in that 3, maybe even 4% range of inflation. If that continues to be the case, there isn't going to be any space for the Federal Reserve to continue to cut rates. I don't see that that's going to happen. So, with that being the case, at this point, as we're looking at 2025, we may get 1, maybe at the outset 2, or higher likelihood at this point, we have no more cuts for this part of the cycle. That doesn't mean in perpetuity. Remember, interest rates are always moving in cycles. We're either increasing, decreasing, or maintaining some sort of short-term stasis as far as interest rates are concerned. At this point, I'm seeing that we're going to either maintain as we are or maybe dip just a little bit more. But if you're hoping for the possibility of those 2% and 3% mortgages that we had here several years ago, I would say, folks, I don't see that happening anytime in the near future. This is not a definite kind of thing. Obviously, we're looking into what we anticipate for 2025, but I don't anticipate at this point that we're going to get anywhere close to where those mortgage rates were here several years ago. Third big item when we're looking at 2025 and what we anticipate as well. And I'm looking at really geopolitical kinds of things around the world. Let me say first that from a geopolitical standpoint, insofar as market impacts are concerned, this has been, on a relative basis, a pretty quiet stretch where we've been in. Let me highlight it a different way. It used to be true that when there was geopolitical upheaval in the Middle East, that we would see dramatic swings in the price of a barrel of oil. We're not seeing that right now. Let me just give you a very narrow example. We just had the overthrow of a 50 plus year regime in the country of Syria that happened in about a week. And it was largely unanticipated by the markets. That would have been the kind of thing where the price of oil would have jumped 10, 15, even 20% overnight. Folks, the oil market barely moved. And I say that not to minimize the significance of the regime change in Syria right now, but to highlight how it's a different market now than it was here several decades ago. When I say different, it's not because we've never been here before, but because the sources of oil, natural gas, and other oil byproducts, i.e. gasoline, have broadly expanded over the course of the last several years, a couple of decades, and that has reduced the shock value of geopolitical impact when it comes to oil prices. Now, I'm saying that to say one of the reasons why I think it's been quieter on the geopolitical impact end of things. What we haven't had with any significance have been significant shifts or geopolitical shocks in other areas of the market, specifically those things which may impact the stock and bond markets. And I'm saying that to say that's unusual. I have to also say right next to it, I don't have any, obviously, inkling that there's going to be geopolitical shock impact here in the relative near term. But we haven't had some for quite some time now. Now, in my end of the world, I'm dealing in probabilities and averages literally constantly all day, every day. So when we're running below the average of those kinds of things, I'm waiting for something that is above average in order to, wait for it, make the average. So if we're running below in terms of our average amount of geopolitical shocks or geopolitical risks, which are baked into the markets right now, I'm looking for a space that may be a little bit higher than that. Again, no knowledge or no understanding that that's on a horizon, but just, yes, more conservative. I'm anticipating that that could be the case somewhere in the future, and we need to be prepared for that from a conservative standpoint. You've heard me say this a lot, and it's happening again now. The markets tend to, especially over times where dot plots are moving in a particular direction, markets tend to start thinking in straight lines. So we've had 2 years of above average growth. I'm telling you, the markets are anticipating very similar kinds of things here for 2025 as well. It may happen. It definitely may happen. But at a certain point, the cycle shifts. That's what makes a cycle. Otherwise, it would be linear in either direction. So I'm anticipating that the cycle is going to shift at some point here. And certainly from a planning standpoint, management standpoint, we're wanting to be ready for that. Not knowing when it's going to happen, but knowing that at some point it will in some measure. So again, as we're looking at those three big items here coming into 2025, then it becomes, okay, should anybody be doing anything differently? To start out with a terrible answer. It's different for everybody. It depends on where you are in your financial life. Are you at the front end of a career, the back end of a career? Are you in retirement? Are you doing estate planning? Are you saving for college? Very, very different answers for everybody. These kinds of things that I'm mentioning to you here are really meant to be more of a function of just be aware of what the environment is right now so that you can make decisions which are most appropriate for you, recognizing that everybody's space is different. At any time, I always enjoy hearing from you, always interested to hear about what you're looking at from a personal financial standpoint, ways in which we can be helpful to you here, but I also enjoy hearing about the good stuff, about how you may have spent your holiday season, travel. If you're one person who likes snow, actually literally as at the time of this recording, I know there's a big storm blowing through the Northeast right now. That may either be a very positive thing if you're a skier or a not so positive thing if you're trying to travel through that kind of mess. Always enjoy hearing about that as well. But at any time, reach out to us. Let us know what kinds of things may be on your radar screen. And always, if we can be helpful to you in any ways, we always enjoy hearing from you. Until the next time when we chat, I'll look forward to talking with you soon.